Good morning.
Morning.
Good morning. On behalf of the Federal Reserve Bank of Minneapolis, welcome to our second symposium on ending too big to fail. My name is Neil Kashkari, president of the Minneapolis Fed. You know, the purpose of these series of symposiums is to have a very honest conversation about whether or not we as a country have done enough to address the risk of too big to fail banks, the risk that we all experienced in 2008, understand what risks remain unaddressed, and look at what options are there to go further to try to reduce those risks. As many of you know, the Minneapolis Fed has literally been at the forefront of understanding too big to fail risks since back to the 1970s. So we're building on a long history and a body of expertise here. Now, these symposiums are going to inform our work here at the Minneapolis Fed. Our plan is to hold a series of these symposiums, all of which is going to inform us as we come up with our plan to end too big to fail, which we're going to roll out to the country by the end of the year for the country to consider. Now, in our first symposium in April, we looked at two options. We looked at one, increasing the capital requirements of banks, and number two, we looked at a breakup scenario, break up the banks. Today's symposium is moving forward looking at two additional options. One option is taxing leverage in the financial system to reduce systemic risk, and the next option is resolution mechanisms, alternative resolution mechanisms to deal with a failing bank once it gets into trouble. And again, we're not going to have a final answer today on what the final result is, but all of this is about educating ourselves, but also educating the American people so that at the end of the year, we have an informed and thoughtful proposal. Now, the most important elements of today's symposiums are frankly all of you. We said early on when we announced this initiative, we'd be bringing together experts from around the country to hear from the best experts, to debate their ideas, and this symposium is a great example of that. Our first symposium did that. This next symposium does it as well. We've got not just expertise on the panels, we also have a lot of experts in the room, and so I'm really appreciative of all of you taking your time, joining us here in Minneapolis, and participating in the discussion. I want to just thank a few of our speakers. All of our panelists are world-renowned in their own way. Just acknowledging our presenters, John Cochran, Luigi Zingalis, and John Bevenzi. As I said, all of our panelists are world-class, and of course, this afternoon, we're going to be honored to have former Fed Chairman Ben Bernanke with us to hear from him as well. I want to acknowledge a few others who are here. President Bullard from the St. Louis Fed. Jim, thank you for being here again today. Jim was here with us last time, has been outspoken on the issues of too big to fail banks for a long time. We have a few of our board members from the Minneapolis Fed, Christine Hamilton, Kate Kelly, Harry Melander, and Ken Powell. Thank you all for being here. Thank the press who are here today. Again, it's critical for us to educate the American people while we educate ourselves. And so I appreciate the fact that the press is here, and we're live streaming this to the public. We had a few thousand people tuned in for the first symposium. I think we're going to have similar interest here for this next symposium. Again, at the end of the day, it's not what you and I in the audience think. It's ultimately what the American people think about whether or not we have the right balance of risk and safety. And so it's critical that the American people are as informed as possible. That's why we're doing all of this completely open and transparent so that they can learn while we are learning as well. After today's formal symposium, I'm going to be having a town hall at the University of Minnesota. Chari, thank you for helping to organize that. John Harwood from CNBC is going to come out and moderate that event with a lot of students from the university. I'm really happy to engage with the students. So with that, let me introduce my colleague, Sam Schulhofer-Wohl, who's going to moderate our first panel. Sam is Senior Vice President and Director of Research here at the Minneapolis Fed. He joined the bank in 2010 after earning his PhD at the University of Chicago and is a key advisor on all policy issues that we work on. And so, Sam, thank you, and I'll let you take it from here.
Thanks, Neil. Let me briefly introduce our speakers today. These are all highly accomplished people, and I'm only going to be able to skim the surface, but I want to mainly allow time for them to speak. Our main speaker is John Cochran. John is a senior fellow at the Hoover Institution and a former professor of finance at the University of Chicago Booth School of Business. He's renowned for his articles on stock and bond markets, interest rates, monetary policy, exchange rates. His textbook on asset pricing has taught most of us everything we know about the subject. In addition, he's a true public intellectual. His blog, The Grumpy Economist, is always thought-provoking, though I hope that he won't be so grumpy this morning. Our panelists, Michael Hassenstab is Executive Vice President and Chief Investment Officer at Templeton Global Macro and Portfolio Manager for Templeton Global Bond and a number of other funds, one of the leading investors around the world in sovereign debt. Michael Keene is Deputy Director of Fiscal Affairs at the International Monetary Fund, previously head of the tax policy and tax coordination divisions there. He's led technical missions to nearly 30 countries on tax policy issues and an expert on the full range of taxation and fiscal issues that arise around the world. Donald Marin is Institute Fellow and Director of Economic Policy Initiatives at the Urban Institute. He previously led the Urban Brookings Tax Policy Center. And he's also served in a wide variety of important government roles, including as a member of the Council of Economic Advisors and as acting director of the Congressional Budget Office. And finally, Tomas Philippon is professor of finance at NYU Stern. He's an expert on systemic risk, on financial crises, on asset markets. He was recently named by the IMF as one of the top young economists in the world. So all of our speakers really have fantastic expertise to share with us today, and we look forward to hearing from them. With that, let me turn it over to John.
Thanks. Should I stand up or?
Whatever you prefer.
Yeah, okay. Oh, and even this works. Good. Thank you very much. It's a really honor to be here. Thanks especially to my fellow panelists who had to read my various scribblings on this topic. So let's dive in. I think it's wise to name, diagnose, and limit the problem you want to fix before we start writing regulations. So we'll get to the regulations part in a bit. I think the right goal is ending financial crises. We'll end too big to fail along the way, but the main goal should be to end crises. Next, we got to define what systemic and crisis mean before we try to fix them. There's a lot of buzzwords in this game. So a couple of what I'm going to say follows from a few premises. My main premise is that at its core, our financial crisis was a systemic run. That mechanism is familiar from Diamond Dybvig, and I find Gary Gorton's description especially good, how information-insensitive assets suddenly lose that property and become illiquid. So you see a problem at a bank, and I'll use that word loosely to mean shadow banks, overnight debt, and other intermediaries. You see a problem at a bank, and you say, oh, what's going on with my bank? You don't really know. The point of short-term debt is you don't generally pay attention to bank assets a lot. But you also have the right to take your money out anytime you want, and you know that the last one out gets the rotten egg. So when you're a little uncertain, you might as well forego a few basis points of interest and get out now. Everyone else does it, and the bank fails. Now, runs at specific individual institutions caused by identifiable problems, that's not really the danger. And you see in my story a specific contagion mechanism by which troubles at one institution spread to another because they cause people to worry about their own bank's assets. And it's that systemic run element that means that banks can't easily sell cash, issue new equity, or otherwise handle the problems of their deposits. So now, that's a nice story, but I think it's important for what it denies and for the problems that we don't have to solve, as well as its story about what did happen. So it's not a chain of dominoes. It's not A fails, B loses money, so B fails, and so forth. And so by saving A, the whole chain of dominoes gets saved. Contrariwise, even saving A isn't enough to ensure investors that B's assets are okay. In fact, if the government has to save A, that might verify investors' worries that something's wrong with B's assets and set off the run rather than stop it. It's also not huge losses on particularly unsafe assets. Bank assets aren't that risky. Bank liabilities are fragile, and therefore small losses can spark large runs. Our crisis and recession also were not the result of specific business operations failing. Failure is a failure to pay your creditors. It's not a black hole where there once was a business. The operations keep going in bankruptcy. The ATMs didn't go dark. So in my premises, the 2000 stock market bust is a good counterexample. My premise is that was not a crisis because it was not a run. Yeah, lots of people lost a lot of money, But when stocks plunge, all you can do is you go home, you pour a stiff drink, you yell at the dog, and you bemoan your dumb decision not to sell yesterday. You can't demand your money back from the issuing company. You can't drive the company into bankruptcy if it doesn't pay. Panic selling, even if it's irrational, even if you're hurting, even if it drives prices down, that's not a crisis. It's not a run, because the issuing company doesn't have to do anything about a stock price fall in the way it has to pay off a run. So if we want to actually stop crisis, we have to describe when we're going to say it's good enough and stop trying to fix things in the name of crisis prevention. So my premise is that an economy with booms and busts, risks taken, losses, big losses, transparently absorbed by falling prices, that's good enough for now. If we try to create a financial system where nobody ever loses any money, we'll just create a system where nobody ever takes any risk and doesn't fund any remotely risky investment opportunity. And I fear that's the direction we're going. I also worry that steps that actually matter to fixing crises are getting lost in an effort to, quote, fix every perceived financial problem. So given these premises, the central weakness in the financial system is now very clear. We have fragile, run-prone liabilities. The answer then is pretty clear too. We shouldn't have any more large-scale funding of risky or potentially illiquid assets by run-prone securities. Short-term debt in particular, but any promise that is fixed value, first come, first serve, and if unpaid, instantly bankrupts the company, and in volumes that could remotely trigger such a bankruptcy. So banks and shadow banks, they must get the money they use to hold their risky and potentially illiquid loans and securities. They must get them overwhelmingly from run-proof floating value assets. Common equity is the simplest, some long-term debt as well. Now, once we've done this, financial crises are over. 100% equity-financed institution cannot fail, and it can't suffer a run. It really can't fail. Fail means fail to pay your debts. And if you don't have any debts, you can't fail. You can go out of business, you can liquidate, but you can't fail. You can't go to bankruptcy. An institution like that doesn't need any risk regulation beyond the regular transparency we demand of public corporations. Dodd-Frank regulators, Uber's looking for drivers. There's a constituency for this regulation. Any remaining fixed value demandable assets must be backed entirely by short-term government debt or by reserves. They're run-proof because there's no doubt of the value and liquidity of the assets, at least for the U.S. and at least for now away from sovereign debt worries. And I'll put that off the table for now as well. So let's talk about objections. The major objection to this vision is the flow of credit. Wait, if banks can't issue deposits and a short-term debt, then they won't have money to lend, the economy will dry up. Lots of other people worry that without transformation, economic growth would be slower. This perception's false. Not 1 cent more or less money needs to be provided. Not 1 iota of more risk needs to be shouldered. Not 1 cent less credit needs to be extended. And I think the case is strong that growth will be substantially higher than the current run-prone but highly regulated system. So I want to look at that, and I also want to argue that this is realistic. It's not pie-in-the-sky free market stuff that someone who calls himself the grumpy economist puts on a blog. So let me do that. Let's look at some structures, very simplified structures. So structure number 1 there, that's a simplified diagram of today's bank. There's lots of complex or illiquid assets on the left. The bank, next step, that's too complicated to go through bankruptcy. It's funded by very little equity and a huge amount of debt, and that debt is prone to runs. People provide the money in the end, but I include here non-financial businesses and institutions like pension funds and endowment. Okay, let's move to structure 2. That's the simplest equity-financed bank. The bank, that thing that's too big or too complex to resolve, that issues only equity and households own the equity. And they'll typically own it in diversified form, like through a mutual fund or an exchange-traded fund. Now look at my structure number 2. Households provide the same amount of money. They shoulder the same amount of risk. the bank can make the same amount of loans. But runs and crises are now completely eliminated. Now you'll laugh, unless this is Minnesota, you're all polite and you won't, but I want you to take this structure seriously for a moment. With today's technology, people can hold floating value accounts. This wasn't technically possible in the 1930s, when our country chose instead the path of deposit insurance and risk regulation. But now, you can easily go to an ATM, you could ask for $20, and the ATM sells you $20 worth of bank shares at the current market value in 20 milliseconds. Liquidity is now divorced from fixed value and runnable. That used not to be the case, because in the 1930s, you couldn't know what stock was worth in 20 milliseconds. The unlevered bank equity on the right-hand side of number 2, that would have a tenth or less the volatility of current bank equity. So we're talking about something like 2% volatility on an annual basis. Now, shouldering 2% price volatility is not hard for the majority of depositors, especially dollar-weighted, which is what counts. To argue otherwise, you need some non-economic psychological theory. You have to believe that the same households that are up to their ears in debt handle 401k accounts, can handle healthcare co-payments, cable and phone bills, vacation in Las Vegas, but somehow they can't stomach 2% volatility in their bank savings accounts. But if you want, you can keep exactly the household assets we have today. So let's look at structure 3. Here, banks are still issuing 100% equity, but that equity is held in a mutual fund or exchange-traded fund or some similar holding company, and that one, in turn, issues equity and debt. So the bank now, again, complex, full of illiquid assets, full of Ben Bernanke's description of the Great Depression, where specialized human capital blew apart. That bank still can't fail. The fund can fail, but the failure of that fund, that can be resolved in a morning, and you'll still make it to a 3-martini lunch and golf. The fund's assets are publicly traded bank equity and nothing else. The liabilities are common equity and debt. The equity holders get nothing, the debt holders get the bank equity. It can be done by computer in a matter of minutes. Now, my funds do have debt, but also there's little risk of a systemic run on those funds because the assets are supremely liquid, they're just common equity, and they're visible on a millisecond basis. So if you see one failing, you don't have to worry about what's going on with your fund because you know instantly. Now, you might object to my structure 2, that the Modigliani-Miller theorem fails for banks, so it would be a higher cost of equity. But now, in structure 3, households are holding exactly the same assets. They must give exactly the same cost of capital minus the value of taxpayer guarantees. Now, structure 3 also, it emphasizes the issue is not whether we have transformation of maturity and liquidity. The issue is not whether people need to hold a lot of fixed value debt, which we also can argue about. The issue is whether that transformation, if you're going to have it, has to be tied up together in the bankruptcy and liquidation of the institution on the left handling the complex assets. You can cook up stories why they have to be in the same institution. Our banking theorists are clever. But are stories like that remotely scientifically understood and tested well enough to justify putting up with financial crises or our massive regulations? I don't think so, but maybe our panelists will try to say why it is that the bankruptcy has to unite the bank and the holding company. Now structure 3 is a rhetorical point. This is not realistic, it's not a proposal. I don't think it's necessary or desirable to exactly replicate the securities on both ends of the current banking system. My point in structure 3 is just that eliminating financial crises by moving to equity finance banking, it doesn't require any new money, it doesn't require any less credit, it doesn't require any less economic growth, it doesn't require any different risk taking, it doesn't require people to hold any different kind of assets. People will likely choose different assets in my world, but that can only improve the situation, not make it worse. So structure number 4 is an elaborated, slightly more elaborated version, a little bit towards what I think the world would look like with equity finance banking. So not all bank assets today are complex, illiquid, hard to sell, and hard to resolve. And once you remove banks' ability to do a lot of short-term financing, I think that their securitized debt and their other liquid securities, those will move off bank balance sheets. And they can migrate to long-only floating value mutual funds and exchange-traded funds. And given that opportunity, people will move their money out of low-return savings accounts and bank CDs into those kinds of very safe investment vehicles. I mean, a mutual fund holding long-only mortgage-backed securities is a very safe investment vehicle. So the banks then will shrink, and they'll hold only the complex and illiquid risks that you can't easily securitize. On the other side, on the lower side, banks now also, not all their assets are illiquid and complex. They're sitting on about $2.3 trillion of reserves. And on the liability side, they've issued about $1.2 trillion of demand deposits. So narrow banking, narrow deposit taking, it's here. We got it right now. Good job, Fed. We just need to move the deposits and the reserves that back them into a bankruptcy remote vehicle, free from the banks of the bank. The banks can still operate that stuff for a fee if that makes sense, but the important part is to move it out to a bankruptcy remote vehicle. Now let's ask, how much risk-free assets do people really need after all? We can provide them a lot. We can provide up to $14 trillion and counting with narrow deposits backed directly or indirectly through the Fed by Treasury debt. So here the Fed's balance sheet, I think, is a great innovation. And we can do better yet. The Treasury should issue fixed value floating rate debt, and then we can all have reserves. The last 8 years have taught us, I think, a revolutionary lesson in monetary economics. Huge quantities of interest-bearing money are not inflationary. We can live the Friedman optimal quantity of money. As our ancestors got rid of run-prone private banknotes in favor of treasury notes, we can get rid of run-prone private overnight debt in favor of treasury and Fed interest-bearing electronic money, and we can have 14 trillion and counting of that stuff if we want it. Let's do it. Okay, so we have defined the problem, I hope, and limited it. We've outlined a better world, but we're still not ready to sit down and do the fun stuff of writing regulations. Everybody wants to jump into writing regulations. First, before you write new regulations, let's check and make sure that failures and unintended consequences of the current regulations aren't the problems, and then we can go adding new ones. There's a tendency to pretend our world is this garden of Eden of unregulated stuff, find a market failure, write regulation, but that's not our world. In fact, banking is already very regulated. So what are the distortions? Our government subsidizes debt in lots of ways. So maybe we should start by not simultaneously subsidizing something and also regulating against its use. We'll leave that to energy policy and how we handle gasoline. And just about everything else the federal government does. So obvious distortions, mentioned many times. The tax deductibility of interest payments is an obvious distortion. It's not the whole story because non-financial corporations don't lever up all that much, but it's surely part of it. Now, what's the answer? I'd rather just get rid of the whole corporate tax, which eliminates the demand for hundreds and hundreds of little tax distortions. But let's not let the ideal get in the way of the practical, at least by treating dividends and interest equally, or better yet, reversing the treatment, deduct dividends, not interest, we could solve that problem. Implicit and explicit debt guarantees are another part of the distortion in favor of debt. Guaranteed debt is cheaper than non-guaranteed debt. Now here I used to say, well, let's end the debt guarantees, but I fear the government will always bail out ex post. The only way to stop a run is by bailing out creditors. Pat and Shari have convinced me, they have a nice paper on how it's hard to do that pre-commitment. And I think the government's inability to pre-commit against bailing out debt is an important reason that we want to limit debt issues in the first place. So while that's attractive, I'm not sure that that's a central part of what we'll be able to do. A lot of law, regulation, and accounting subsidizes debt as a liability by privileging debt as an asset. So liquidity regulations encourage institutions to hold a lot of short-term debt and to have that run option that each institution can save itself individually in times of trouble and look safe individually. But of course, that incentivizes someone else to issue the short-term run-prone debt, and it encourages the fallacy of sell if things go bad risk management. A stop-loss order is not a put option, though lots of people don't get that. Accounting regulations treat run-prone short-term debt as safe as cash, and you get a blessing of safety even though you're contributing to the problem. Using floating value funds for transactions purposes, as we can do with economically, but that would now trigger a nightmare of short-term capital gains taxes and accounting. Well, that's easy to fix if we want people to have liquid, floating value, run-proof assets to do their transactions. So in sum, throughout the regulatory system, we should treat non-government short-term debt as poison in the well, both an asset and as a liability, and we should remove the impediments to the use of floating value assets for fast transactions. Now, will that take some effort and some lawyer time and some regulation time? Yeah, but just carrying the tens of thousands of pages of regulations over to the Dodd-Frank bonfire will take some effort. So we're allowed to do a little effort here. Now, regulatory relief would be a potent carrot, and really it's my strongest suggestion. We could say any institution that's financed by more than, 75% equity in long-term debt is exempt from asset risk regulation, systemic designation, bank regulation, and all the rest of it. We'll treat it like any other non-financial company. If it gets an attaboy, you're not a systemic danger. I suspect they would come running. And this suggestion reflects a deeper problem. Where is the safe harbor in the Dodd-Frank Act and all financial regulation? Where does it say, look, here's how we want you to set up a company so that it's not a systemic danger. It's systemically safe. If you do this, you get the systemically safe badge of honor. You're doing a good job and we'll leave you alone. Nowhere. Not even an equity exchange traded fund, which is about the most run-proof structure in existence, is exempt. And in fact, the OFR was proposing to regulate them for their systemic dangers. Now, adding a safe harbor is also, I think, attractive as a way to move to better policy politically. If we need to repeal the Dodd-Frank Act, that's asking a lot. Too many people have way too much invested in it. But if we just added to the Dodd-Frank Act its missing definition of what does systemic mean anyway, and thus a definition of what is not systemic, a specification of how an institution can set itself up to be exempt from detailed regulation, then they'll all run for it, and the rest of it can just die on the vine. So finally, at last, we've defined the problem, we've limited it, we've said where we want to go before we start regulating. We've talked about how to get rid of the current, how to remove the current regulations that are causing the problem. If after removing all of that and a regulatory safe harbor, banks are still using too much run-prone financing, okay, we get to add a little bit of stick to the carrot. Now the usual approach to boosting capital combines complicated regulation, the limit of various ratios, with a lot of discretion and regulatory remediation. And these ratios don't work for all sorts of reasons. And really the denominator is the big problem. So leverage, debt to asset ratios, that's silly. We're now requiring equity to holding reserves at the Fed. And a stock versus a call option have much different risk for the same value of assets. Risk weights supposedly are better, but they violate the fundamental principle of finance, that a portfolio is less risky than the sum of its parts. And risk weights are deeply distorting investing decisions. Loans carry big risk weights. The securities formed of the same loans carry lower risk rates. Greek debt still has zero risk weight. And what level of capital is safe? 17.437%? 35.272%? I mean, really the answer is so much that it doesn't matter, and more is always better. And since costs and benefits don't suggest a hard and fast number, why regulate a hard and fast number and then get into endless fights about just what it should be? So we need something simple, transparent, and that avoids these pathologies. And the best I can think of here is a Pigouvian tax. 5 cents, say, on each dollar of short-term debt, maybe 2 cents on longer-term debt. By taxing the raw amount of the debt, the arguments about the denominator vanish. So we don't have to even bother with risk rates, leverage, book values, and so on and so forth. Everywhere in economics, charging a price is better than setting a quantitative limit. Now then you'll ask, okay, well, just what's the right tax? And I'll have to answer, I don't know. I suspect that the benefits of short-term financing are much less than the banks claim when they're screaming to regulators to lower a quantitative limit that doesn't cost them anything. If they faced even a quite low tax, I suspect we would see a swift conversion experience and a rediscovery of the Modigliani-Miller theorem. And in any case, we don't have to decide the level of the tax ahead of time. Just put one in, then you can adjust it as you need to until you get the capital ratio you want. It's sensible to demand more capital of more dangerous firms, so the tax could rise on simple measures of danger. Again, I still distrust any accounting measures, so following Chari and Pat's recent suggestion, the tax could be a rising function of the ratio of short-term debt to the market, not book, market value of equity. That's easily measurable, and then let the firm figure out whether to issue more equity, retain more earnings, find a buyer, restructure debt, or pay the tax for a while, whatever they want to do. But most important point here, we're not trying to carefully craft a way for banks to get by on the absolute minimum amount of capital. The point is that capital isn't expensive, at least socially, if not privately. We don't want to jigger the absolute minimum out of the tax. We want the tax to be enough to induce banks to shift overwhelmingly to floating value, run-proof securities. It's like a tax on cigarettes. Now this all may seem a little bit radical. So I want to emphasize, let me see, where am I here? Yeah. Oh yeah, here we go. Before you complain. This is to you guys. I want to emphasize just how broken the current system is. Since the 1930s, we made a big decision, and the equity finance banking was on the table. Our country said, no, we're going to go in a different approach, an approach that minimizes equity and has lots of debt. When depositors run, really the only way to stop it is for the government to guarantee debts. Once people expect debt guarantees, banks take too much risks, and creditors lend to banks without regard to that risk. So we tried to substitute regulatory supervision of asset risks for both ends of market information processing and discipline. It wasn't enough. We have another crisis. We guarantee more debt, and around and around. The little old lady swallowed a fly. She swallowed a spider to catch the fly, and so on and so forth. And now she's trying to digest the horse. That we are having a conference on too big to fail right now reflects the widespread perception that we have not ended this cycle and that past the horse, the elephant is coming. The resolution authority won't work, and that it'll institutionalize creditor bailouts rather than to pre-commit against them, which might be impossible and unwise anyway. Regulation quickly failed its first test after the 2008 subprime crisis. The horse left the barn door, and Europe's bank regulators, with the crisis fresh in the rearview mirror, still allowed Greek debt at zero risk rates, and they promptly bailed out the French and German banks that were overexposed. And we count on the same regulators to artfully diagnose and prick asset bubbles, see imbalance, raise capital standards, promptly resolve nearing failures, sternly haircut debt holders next time. We're devoting enormous resources and suffering large economic distortions to regulate bank asset risks. But bank assets aren't that risky. What's risky? SpaceX's rockets, Chipotle's efforts to give you a burrito that won't make you sick. A diversified, marketable portfolio of loans and mortgage-backed securities is a very safe asset. It's way safer than the profit stream of any company. So why are we as a society investing so much effort to regulate some of the safest corporate assets on the planet? Because they're leveraged to the hilt and we're holding the bag. We don't have to. Asset risk regulation is now spilling over into efforts to regulate asset prices themselves. For example, the OFR proposed to regulate equity asset managers, the ones I want to give a gold star non-systemic to, even though they just trade equity in separately managed accounts on customers' behalf. Now, why do that? Because the managers might sell. They might drive asset prices down. Somebody somewhere might have borrowed money on those assets that the asset risk regulator didn't notice, and we have a problem. Macroprudential policy is the idea that the Fed should allocate credit to target house prices, raise interest rates to manage stock prices. The result of all this is an increasingly uncompetitive and sclerotic financial system. We're the financial system of zero interest rates where nobody who actually needs one can get a loan. And already financial innovators are springing up around the banking system, the peer-to-peer lending, financial technology, and so forth. These give me a lot of hope. Maybe equity-financed banking will spring up like weeds around the ruins of the big banks. But those don't have to be ruins. In any case, before you complain too much about costs, credit availability, or growth in my equity-centric world, keep in mind the large costs and distortions of the current system. I mean, suppose it does cost 25 basis points more for home mortgages. Rather than all this, if you really want to subsidize home mortgages, let's just write checks to homeowners on budget rather than set up such a dangerous or sclerotic financial system. Thanks.
Okay, so our panelists will each have 15 minutes. Start with Michael Heidenstadt.
Great. Well, thank you, and I want to also thank President Kashkari. I think the idea of making this a transparent, open discussion with the public is absolutely critical. Otherwise, this debate will be run by Hollywood, and while I love The Big Short, one of my favorite movies, I think we do need to kind of move beyond people in bubble baths describing CDOs. So I think that is important, and then also I think John's approach just fundamentally is the direction that I think we need to go after so many years of overregulation creating unintended consequences in a cumbersome system. I think the idea of simple is good is absolutely the way forward that we need to go. I mean, I think about our business, which is an unlevered conservative mutual fund, and we have more lawyers than are people in this room. So we have created a lot of costs and inefficiencies in what we've done. Even if the intentions were good, the unintended consequences, I think, are starting to have real costs. So something that is simple and can transfer those people to Uber drivers, as you suggested, maybe is a good thing. I also think the concept of fundamentally that risk is not bad. And I think this is a concept that has been distorted in ways some of the regulations have gone, is that you just don't want to take risk. But if we don't take risk, innovation and the whole capital market system collapses. I cannot disagree with most all of the, many of the statements. You know, Greece being 0% risk rated seems wrong to me. You know, a lot of very, I think thoughtful comments in there. So I wanted to focus maybe my comments more as areas that I think we might want to explore in phase 2 of this idea, is how it affects the markets, how it affects not just the bank side, because I think there's been a lot of focus on how this type of work would affect banks, but how it affects the investment side, which relates to how we manage people's retirements, how 401ks are managed, and those are all inherently linked to how the market function that banks provide is affected. So the 3 areas I wanted to bring up. One is, are we solving one problem and creating another problem? I think we really need to think through that. The second is, logistically, how do we actually get to 100% equity? I mean, I think very clear what that would do, but the mechanism to get there, I think, potentially could be quite dangerous. And then third, are there short-term macro implications of that path that could further a recession, further a contraction in credit growth that the world right now is maybe is ill-equipped to deal with. So first, on the market function, banks, in my mind, simplistically have 2 roles. One is the lending activity, but the other is the markets function. And as regulation empirically has been increasing capital adequacy ratios, decreasing the leverage, which may be good in one sense, it has been massively decreasing the ability of these large market participants to help facilitate market transactions and create price discovery. And as you take away market participants, you increase a lot of volatility, and then you decrease price discovery. And this has an adverse effect both on the investor as well as the issuer. So I think we do need to think, how would something like this, would it increase the ability of market-making functions, or by just scaling these institutions way back, we better hope there's something on the other side that can provide that market function that right now has been decreased. The other area, I guess, is this getting to 100% equity. If you're asking for banks, huge banks, to all of a sudden issue 100% equity, I'm certain that the market could not absorb that amount of issuance. There's no way they could get to that, pay off their debt. That amount of issuance would drive down, stock prices, and I think it could have a very vicious cycle if we are forcing banks to issue tons of equity. If the other side is that they just need to retire all their debt, well, then there's no credit expansion. I think what the ECB has been trying to desperately do is to get credit growth going on by unconventional policies to an nth degree. Something like this really just goes against that whole desire to kind of get credit creation going in the system again. So I think we want to be careful that we don't design two opposing policies. Well, on the one hand, we have Federal Reserve Bank, BOJ, ECB trying to extend credit, and we put in place a policy that directly sort of contradicts that. I think that could have consequences that at least we need to think through. There was one idea in the paper about creating SPV, and SPVs scared me. They got us into this trouble. So anytime I see SPV as a solution, I'm a little bit cautious, because the idea is that you could pass the risk to this entity, so the bank wouldn't have the risk, and then they could issue debt. And if the debt defaulted, then the SPV goes down, but it doesn't fall back in. True. The only concern there is that who owns the debt of the SPV? And it's probably going to end up being public pension funds. And so, if you've just transferred this risk to another group, the government could ultimately be in a position where if you have huge unfunded liabilities, you have public pensions that are in real trouble, there could be political pressure from a different angle that you got to back those up, because we can't have all the retirees, losing their account. So I guess I would like to think through more, how does the mechanism of that SPV translate, and so that it doesn't create a new systemic risk. And it very well could be structured maybe so that it doesn't, but that's just my inherent worry of using an SPV to offload risk, because ultimately someone has to take that risk, and you're just changing who does, and the new actor could be just as vulnerable as the old one. I guess then the other concern I have has to do, with the effect on credit expansion. It would seem like we'd need some discussion of what are your estimates that this will do on loan creation? Is it going to contract loan creation, stay steady, or allow it to expand? And I think until we can answer that question empirically, it's hard to get my head around how this would work. The other, I guess, just two last small issues would be on would this lead to the end of big banks just because of the nature of the program, and we would have a lot of small banks? I know there were problems in the big banks, this whole too big to fail, but large banks in this new global economy provide a very important function that allows U.S. investors, U.S. corporations to operate on a global scale. And if for some reason they have to scale back so much that they can't have that global reach, then I think other countries and their banks will move into that role, and we certainly will lose competitiveness in our financial industry. And I just think from our simple one angle of a global investor, we need to be able to access markets in every country in the world, and do it where we have 100% confidence that our investments and the trades will be collateralized, that they will be good investments. So that institution needs to be big and solid, and they need to have the global reach. Once you get rid of the big banks, you have no more global reach. How are we going to invest 401ks in emerging markets in Indonesia or Malaysia through a small regional bank? They have no way of doing it. So I think, while we've focused a lot on the concerns that big banks have created, I think there is also value, an important value, that they do provide to investors and our ability to manage people's retirement, and companies to access different parts of the world that we need to consider. So I guess the question for this isn't proposing getting rid of big banks, I realize that, but would the implication be to get rid of big banks? And we just need to at least evaluate the costs of that and consider those as costs when we make that decision. Then lastly, just as one last observation, your last, I think, page, you said, well, if this all works unless there's inflation's a problem. But my bias is that, and I know this is probably very out of consensus, especially in this audience, I think inflation will become a problem. But maybe that could be solved by using TIPS or some inflation-protected security as your short-term liquid asset. I don't know, but that might get around that problem if it does come up. But again, all in, I think I was excited to see this because I think it's moving the debate in absolutely the right direction. A lot of it makes tremendous amounts of sense. And my only, I guess, recommendation was the next step, I think, needs to be a consideration of empirically how this would actually happen, and a consideration of potential externalities or costs that this would have on the marketplace. And if we consider those and we can get comfortable with them, I think this is exciting, but I do think there are certain, as just an applied practitioner, questions that are open in my mind on that implication.
Thank you. Michael Keane.
Thank you very much, and it's also a great pleasure and honor to be here. I was very happy to be invited. Confess I'm a little bit intimidated. I'm not a banking finance regulatory guy. I'm a humble public finance tax guy, and as you know, we're very humble people. Perhaps actually too humble, and I'll come back to that maybe later on. Maybe a couple of points I wanted to make right at the front to make sure I don't forget to say it. One is that really I think it is very grateful for today for actually bringing together the tax and the banking people, because I think it's been pretty shameful how little these two groups have interacted and thinking about these issues over the last few years. And really we're talking about externalities of various kinds, and when we, in every other area of human endeavor, when we come across externalities, we try and have a conversation about whether we address this by tax or by regulation. And that seems to be still a conversation that we haven't really had in a very serious way. Second point I wanted to make is I think one of John's central messages is very much music to my ears. The paper spends a little bit more time than John did talking about the bias within the corporate tax system towards debt finance as a consequence of being able to deduct interest but not being able to deduct return to equity. And I think he makes the point that it makes little sense to kind of regulate firms to hold equity and on the other hand give them big tax incentives to hold debt. And that's a message we've certainly been trying to send at the fund. We sometimes think we've been whistling in the dark about that, but I think we'd very much like to see that getting much fuller recognition. It does, at least prima facie, that doesn't seem the most sensible constellation of policies one could think about. And then we end up talking about things like COCOs and things which I can never quite understand as other than a kind of artificial artifact of this basic asymmetry in the tax system. So what I'll do in my remarks in a moment is focus on a couple of things. One is, does this, what we call the debt bias in the corporate tax system, does it really matter in an empirical sense in the financial sector? And secondly, to say a little bit about what has been done about it and what could we do about it on the tax side. But maybe before that, it may just help to give a little bit of the context of the tax side of this debate that's been going on a little bit in parallel with the kind of issues we've been discussing so far over the last few years. So before 2010, public finance people knew there was this debt bias in the tax system. Very many worthy papers trying to empirically estimate it, but basically nobody thought of it really as a financial stability issue. 2010, and my account will be, I'm sorry, very IMF focused. We were asked to take a look at whether there were any tax lessons from the crisis. So we talked about housing, managerial incentives, carried interest, all these kind of things. And we also talked about debt bias, not to say it was in any sense the proximate cause of the crisis, but maybe it didn't help. At that point, when we talked about debt bias, basically people thought we were crazy. Nobody really recognized, they thought we were kind of just completely off the wall in thinking that was an issue. 2012, rather, the Obama administration proposes I think it was a financial crisis responsibility fee. G20 asks the IMF to report on taxation of banks. And we did come out with a report which I think did two things that were quite useful. One was to set out a kind of intellectual framework for thinking about the taxation of the financial sector, which had a number of elements. One was, well, let's try and fix problems in the current system before we try and invent fancy new taxes for the banks or financial sector more generally. Step one would be to eliminate this debt bias, to at least establish neutrality between debt and equity finance. Step two, maybe you want to go beyond that and say we don't simply want neutrality. We think there are particular externalities, whether of collapse or in terms of consequence for bailout expectations. If there are these externalities, let's think about addressing those by a specific tax. There were, I should mention, a whole set of other issues in the financial sector which are really to do with its treatment under the value-added tax and the sales tax in the US. I'll put those aside, but those are actually quite important issues as well. And then secondly, in terms of action, the 2012 report did actually propose a bank levy. As I recall, the base was to be non-equity liabilities other than insured deposits. So we came out with a proposal. And actually in the following years, there was quite a lot of action on this. So we do have some experience to try out some of these tax ideas on. So I think 12 or 13 EU member states have actually introduced or have had bank levies of various kinds, of really very different types. There's also been some movements towards addressing debt bias, and I'll come back to that. So this is where we arrive at today. A lot of this debate actually has been sidetracked into this, I think, rather unproductive discussion on financial transactions taxes, which have sort of captured the imagination of civil society and other groups, and I think have actually detracted from these more fundamental issues that we might reflect on. So it's interesting for me to know whether today, and John's talk is actually now going to be a resurgence of interest in addressing the potential tax issues, and whether that's coming from a kind of dissatisfaction with where the regulatory process has taken us in the last few years. So coming on to the couple of things. One, does it matter? So if we say, well, does this debt bias matter? So can we actually find evidence that debt bias affects banks' financing decisions? First thing, of course, we did when we took on this work was to look at what the existing empirical evidence said, and there was empirical evidence that taxes influenced, it led to, debt bias led to higher leverage. But when you looked at the studies, in fact, everybody had always thrown out the financial sector. First step, get the data, throw out the financial sector for some unknown reason, presumably because it's all different in some way that we public finance people didn't really understand. So one of the things we did was actually to do the same kind of exercise on a largish panel, cross-country panel, micro-level data, about 60,000 observations, to look at whether we could find debt bias impacting banks, and these were just banks. And the answer was yes, and the effect was about as big on average for banks as it was for non-financial corporates, which was quite striking. A couple of nuances. The effect was certainly smaller for bigger banks, and it was smaller for banks that were closer to where we took their regulatory requirement to be. And of course, in some sense, it's the big banks that we care most about at this point. So you might say, well, okay, maybe it doesn't matter for these guys. But of course, those are also, since they're also the ones that tend to be operating with very high levels of leverage, we know, or at least you tell me if I'm wrong, I think the literature says that the relationship between leverage and the probability of crisis is very strongly convex. And so when you get in this dangerous region, actually small changes in leverage can have quite a big effect on the probability of failure, and multiply the probability of failure by the very large social consequences of failure, and you get big numbers in terms of the cost of the distortion involved. So the kind of numbers that we get, for example, this is all, we're kind of extrapolating ridiculously, but if you were to start with a corporate tax of 25% and the debt bias corresponding to that, eliminating that might increase equity over assets by about 6.5 points. So it's quite a big effect from eliminating the debt bias, which you don't need to eliminate the corporate tax, of course, to do that. Which brings me to the second sort of question. Well, what should be done about it? What could be done about this debt bias, and perhaps going further and have a Pigovian corrective tax, and what actually has been done? So in principle, what would tax people say you might do about this debt bias? So, which remember is the asymmetric treatment that allows you to deduct interest but not a return to equity. Well, there are two things you can do, basically. One is you can eliminate interest deductibility. If you're doing that for the whole business sector, the basic premise that says, you basically give a deduction for things that are then being taxed later on, and you tax things that have been given a deduction at somewhere else, would say that you shouldn't then tax the interest received. So now you're saying that on banks, we're not going to give them a deduction for interest, but we're not going to tax the interest they receive, which basically means they're not going to pay much tax at all, which may be the right answer because you'll get the revenue somewhere else, but has some problems in terms of political economy. The alternative is to say, well, let's give equity the same kind of treatment that we give to interest. And the most elegant way to do this, I think, is not simply to give, not so much to give a deduction for dividends, but to adopt what's sometimes called an allowance for corporate equity scheme, an ACE, ACE, allowance for corporate equity. What does this do? This says keep your interest deductions, but we will give you a deduction for a notional return on equity. A notional return on equity. So we will take your equity base, we will apply a notional return to that, and the simple theory says that should be a risk-free rate, whatever that is, and you get to deduct that as well. So you deduct interest, you deduct a notional return on equity, which of course establishes neutrality between the two. The even more sophisticated variant of that says we won't give you deduction for your actual interest, we will give you a notional deduction for your interest of the same kind, which basically means we give you a notional deduction or a deduction for notional return on both your equity and your debt. The rate is the same. All this nonsense about the debt versus equity goes away. That's called an allowance for corporate capital. But the one that's most often discussed is the allowance for corporate equity. Now, as a further variant that's been proposed, one thing we had wondered and would be interested in any views audience and participants may have, we've tended to think about this usually as applying to all corporates, not particularly for financials. But at the fund, one idea we've sort of been playing around with a bit is why don't we just do this for banks, somehow defined? Why don't we just do this allowance for corporate equity scheme simply for the financial sector? We'd like to do it for everybody, but maybe it would make sense just to do it for the financial sector. And that gives rise to a further variant that I think colleagues at Harvard Law School propose, which is to say to minimize the revenue loss, we only give the deduction for, in relation to equity, in excess of what the regulatory requirement is, which is just, it has no effect on marginal incentives, but saves us some revenue. So this, I think, is what we would typically see as the most elegant way of addressing the debt bias. And the step two, then, at that point, all you've done is restore neutrality between debt and equity. Some people would want to go further and say we actually want to tax disfavor debt because we think there are particular externalities involved in it, and that's where we would come on to a specific kind of add-on bank tax or bank levy to reflect the social costs of either of collapse or of the social costs of the anticipated bailouts. So what's happened in practice? I think we have a fairly clear agenda of what we could do. What's happened in practice? As I mentioned, there have been quite a lot of experiments with bank taxes in the EU, very different kinds. Some differentiate between short and long term, some are linear, some are progressive. My understanding is those are now to be used to finance a common resolution fund. The UK is actually abolishing its bank tax, partly because it actually raised quite a lot of money. It actually always raised more money than they expected every year. So they're getting removing this special tax on debt liabilities and instead increasing the rate of corporate tax on banks, which of course goes kind of completely the wrong way in terms of making the debt bias worse and not offsetting it through the special tax. I should say too that on the allowance for corporate equity, when I described it, you might have thought, well, this is completely interesting, but clearly no one's ever going to do this. In fact, several countries already have this. Belgium has this. Italy has probably the best designed ACE. Belgium has actually been work on how it has led to better capitalized banks. Turkey, Brazil has something with some similar features. Austria had something of this kind. So this is not a kind of outrageous proposal. These are schemes that have actually been applied and that actually, as far as we see, and we've looked, for example, at the Italian one in some detail, work pretty well. And they have, I should say, a number of other benefits. These are all schemes applied generally. No one that I know of applies it just to finance. But as far as we can see these all work pretty well, at least as well as the corporate taxes they replaced. So I think I'll leave it there. Just to say, I think certainly on the tax side, we're I think very much on board with many of John's ideas. I think there's a lot still to do on the proper design of the Pigovian tax. Except there's one thing I forgot to mention. There has been some work done on the impact of these bank taxes in Europe, and even though they're at relatively low rates, they have actually encouraged greater capitalization. There's, because of the, the risk weighting aspect, there may have been some increase in measured riskiness, because you kind of cut leverage, but then you take on more risky assets in the denominator. But we can certainly, the evidence is that they have had a measurable effect, even though they're at pretty low rates. They're certainly at rates far from what would be needed to counteract the basic debt bias. So a lot more to do. I think it's true that we still lack a good story of tax versus regulation. I think, as I was said at the outset, intellectually and practically, I think there's a lot to be done in terms of the regulatory and public finance people working better together. I think the public finance people have been too humble. I think we've probably been too easily scared off from getting into a lot of these issues. I think the mantra has been, don't worry about it. We're going to sort it all out. We're going to change all these, we're going to have Basel III. Everything's going to be sorted out. I kind of wonder if that's completely true. But I will leave it there. As a tax nerd, I will avoid going into the links between these tax leverage issues and a multinational tax avoidance. But that's actually another element of this whole debate that we're going to have to sort out and deal with appropriately. So I'll leave it there. Thank you very much. Thank you.
Thank you. Donald Marin.
Hey, so hi everybody, it's a pleasure to be here. I'm going to sound a lot like Michael in some regards here. So I am currently spending most of my time thinking about tax and budget issues, a little bit about finance. I did have a chance to work with Neil back in the darkest days of the financial crisis when I was at the White House and he was Treasury. And some of the discussion today about special purpose vehicles and auction rate securities has brought back nightmares. But I've left most of that behind. I think mostly about tax policy. And again, I'm here I think today to be one of the tax nerds. I want to second and third and quadruple Michael's remark about the benefit of having people who think about public finance, and I would include also industrial organization who think about regulation. That group talk more to the folks who think about finance and finance regulation, that there's a lot of things that we think we have learned in environmental and safety and health regulation and policy that we think would be of benefit over in the financial community. And I also just want to, and pardon my voice, I lost it somehow last night. I want to emphasize that this idea of taxing things that are problematic is really widespread in the economy, if you haven't noticed. So there are enormous discussions going on in the environmental community about taxing carbon emissions as a way to combat climate change. Obviously, longstanding issues of taxing cigarettes, taxing alcohol. There's a very active discussion right now about the sugar that we have in drinks. If I were on one of the coasts, I would refer to this as a soda tax, but I'm told I should refer to that as a pop tax here. There's issues about taxing marijuana. There were, Hillary Clinton made headlines a couple weeks ago with talks about taxing opioids. We have special taxes on health insurance, although those have been delayed. It is a very common theme, and I think the thinking around those that is developed can actually be quite helpful here in thinking through in the financial community. And so I wanted to start my remarks just kind of thinking big picture, which is kind of what are the problems that prompt the government to want to intervene in the economy, and why do taxes show up? And ultimately, which type of problem we're solving might influence how we want to design a policy response. So obviously there's the concern about externalities, right? So your financial institution goes into debt and one day you blow up and that causes pain to me, causes the economy to suffer. And so there's a question about how we internalize that externality so that you think about that. There's the classic moral hazard concern, which is separate from that systemic risk. If you know the government's going to bail you out, you might take on more risk because you know kind of heads I win, tails the government loses kind of thing. So you may want to use a tax to combat moral hazard. Michael Lewis's more recent famous book, Flash Boys, you could read in economic terms as basically being a story about rent seeking, or many people would interpret it as a story about rent seeking. And the idea of financial transactions taxes has really caught on in certain circles as a way to limit that kind of activity that seems wasteful to some folks. The cigarette and pop tax discussion is what's become increasingly called in the community the internalities problem, that it's not just that people sometimes make actions that hurt other people, but sometimes they make mistakes that hurt themselves, and that maybe a tax might be a way to help them make better decisions, for example, discouraging them from smoking cigarettes or drinking sugary soda. I find that many of the conversations I have about the financial community often eventually get around to the belief that there are actually people making systematic mistakes out there, sort of the picking up nickels in front of steamrollers problem. And so you can imagine wanting to tax nickels or tax steamrollers as a way to address those. And then notice that there's also another strong theme here about, well, even if the market isn't messing up or it's not a moral hazard caused by the government, there may be a whole set of other government policies that are causing us problems, and a tax could offset those. And there's actually a very famous example of that in health insurance, where we have the biggest tax subsidy in the United States is actually for health insurance. And as part of health reform, we created a new tax on insurance companies and expensive insurance plans to try to lean against that. Washington being what it is, that's been delayed several years. But in principle, you could use a tax measure to try to undo something that the government is doing elsewhere. I'm going to talk in terms of externalities, but that was just to tee up that, in fact, sometimes the concerns that people express about the financial sector may not be technically externalities, and that may be relevant. As John discusses in the paper and the conversation has hinted at, one traditional impulse of government in dealing with these problems is direct regulation, and you can see in the financial sector an impulse among some to really want to get into the details of how people run their businesses and directly regulate how you compensate people, what you own, what your asset mix is. And certainly the literature on environmental regulation and health and safety regulation suggests that that is a dangerous path to go down. Because you can end up in situations where the cost of the regulations become disproportionate to the benefits that they're delivering, and that there may be better ways to go. Now, that by itself doesn't mean you have to go all the way to a tax. We've seen an evolution over time in regulatory policies to more performance standard type of views. So instead of regulating what you do, I want to regulate what your output is. And so you can think about stress tests and things like that as being a step in that direction. That you have a lot of discretion inside your firm how you're doing things, but I'm going to look at what your output is or what risks you're posing and see if we can regulate that. There's often the case to be made that that's going to be a more efficient way of doing things. Or you can go to market-based regulation and think about levying a tax, putting a price on something so that people take it into account in their decision-making, or going onto a cap-and-trade system where you impose a quantity, the quantity gets triggered, and a price emerges. One thing I want to push back on what John said is I want to emphasize that there is no theorem in regulatory economics that a price is better than all other instruments. There are situations in which a quantity measure may be better. And for me, one of the interesting open questions is if you think leverage is a problem, which I tend to sign up for, there is an interesting question deep down about analytically where the problem is price or whether the problem is quantity. And so we can come back to that. Now, there's another issue to address first, which is some problems in markets are so bad that the correct answer is zero. And so the most famous example in air pollution regulation is lead. Turns out the right amount of lead in gasoline is zero. And so that's where we ended up in 1996. Now, we actually used some market-based mechanisms to get there along with direct regulation. So we regulated gasoline, then we created a cap-and-trade system for gasoline, but the point was to get to zero. And I would read some of John's paper and some of John's remarks as actually arguing for zero for certain types of leverage. And if that's really the answer, a tax isn't actually your optimal tool. It might be part of the policy mix you use to get there and kind of a gradual glide path. But if the answer is zero, you also ought to just figure out a way to say the answer is zero, and a tax is not going to kind of be the essential point for you. Second challenge for a tax is what if taxes work best if everyone in the economy, when they engage in the taxed activity, is creating the same externality. And so this is why essentially all economists think you ought to tax carbon, right? Because carbon emissions have the same effect on the global environment regardless of when and where they're emitted around the world. It is a rare case in which you have something that literally looks like the textbook example in Econ 101. It's just beautiful, right? Tax carbon, sign me up. Once you get away from that, though, you start grappling with this fact that when people take an activity, it has different effects. And the more heterogeneous that is, the more differences there are, the weaker a tax is as an instrument. Because at least in a textbook, you would choose a tax to be roughly the average. There's some nuance around that. But you basically be setting the tax to be the average problem that's created, which means you're going to overtax the people who are creating less harm, and you're going to be undertaxing the people who create a lot of harm. And so if there's a lot of heterogeneity, a tax is going to be a weak instrument unless you can figure out a way to calibrate it to the damage that people pose. And so a question is whether you can do that in this world. And then a third result, which is a famous Marty Weitzman paper from 1974, which there's sort of a rule in Pigouvian taxation discussions that you have to cite it in any paper about Pigouvian taxation that talks about prices and quantities, is he compares a price instrument and a quantity instrument and shows that, in fact, the choice among them depends kind of on the heterogeneity point I just made, but in an uncertainty context. That depending on what the risks are of being wrong, because inevitably your price or your quantity are going to be wrong, you want to think about, well, which is worse? Is it a big bigger mistake to miss on the quantity side or a bigger mistake to miss on the price side, and that can guide you as to whether you like a tax or a quantity measure. And so again, there isn't a theorem that says price is best, right? For some policies out there, for some problems, a quantity is best. And the example I would give you there is fisheries management, right? It turns out almost always the optimal way to manage fisheries is to ensure that you have a sustainable stock so that you have fish next year and the year after and that you don't overexploit them this year. The odds of overexploiting them this year are much higher if you're using a price instrument to try to control it, because in years when fish are really, really valuable, the tax doesn't do enough to discourage people from consuming the fish. Now, maybe you can update the tax in an organic way, but that's a hard thing to do. And so it turns out the optimal way to manage most fisheries is with a quantity instrument, not a price instrument. And so if I leave you with nothing else, the metaphor I want to leave you with is the leverage problem like lead, where you want 0. Is it like fish, where you want a quantity measure? Or is it some sort of thing like carbon, where you think a tax is optimal? And I think that's an interesting set of questions to face. And then I just want to note that one of the key things between a tax approach and a regulatory approach is the money. Because it turns out if you tax people and the optimal amount of their activity isn't 0, they end up sending you checks. And so from many people's point of view, that's a good thing. But do note that that affects kind of the whole political economy of it from the point of the view of the firms that are being regulated. That firms that are being regulated might actually prefer a less efficient way of having their conduct controlled if it's more expensive to implement, but it doesn't involve sending money to Uncle Sam. And so you have to think about if you're going down the tax route, there's going to be money changing hands, and that changes the political economy of what's going on. Alrighty, so more political concerns. So the number one political concern for anyone who wants to go down this route should confront is the T word versus the F word. If you talk about taxes, there is a group in society that gets really, really twitchy. If you talk about fees, some of the previous group can see through that. Some of it doesn't. And so you will see in the carbon tax discussion, there is enormous discussion about carbon fees, carbon prices, carbon contributions. Get out your thesaurus. And there is a group of people for whom that is really a salient thing. But it also maps onto an important how we run the United States budget, how we do policy, which is oversimplifying dramatically. In general, it is Congress that levies taxes, whereas it is agencies that collect fees. If your vision is of doing a tax, you're basically saying, I want Congress to set the right price for things. And John told a story about how, in principle, you could do this in an iterative way, right? The optimal way to do almost everything in life is iterative, right? Get started, run the experiment, update intelligently as you go along. You may have noticed that that is not actually a description of how Congress works. And I would give you the example of the gasoline tax. The gasoline tax is unchanged in 20 years, right? We could have interesting discussion about infrastructure and the externalities of gasoline. But the odds that the optimal gasoline tax is the same today in nominal terms as it was 20 years ago are slim. But it is just incredibly politically difficult to update taxes, right? You can sometimes update them to 0, which is what we've done with a couple of taxes. But the idea that you're going to go through Congress and have them update is a really challenging thing. And this is a big issue, again, in the carbon tax community, because the odds of getting the carbon tax right to begin with are really tough. And so you think about, is there some mechanism where it can organically update over time and I don't have to go back to Congress? And that's a thing to think about. Or if you want an expert to involved, you really want to go with the F word, and you want to talk about fees and think about, is there a structure where you can delegate to a regulatory authority to set what the fee is and give them the authority to update it in a way that doesn't make Congress twitchy? And that's, important political thing to do, hard to do. Another thing that comes up in the carbon context all the time is that there are a lot of folks, including me, who will say things like, if we levy a carbon tax, we can get rid of a lot of regulations. And kind of that's like what the logic all leads you to, right? You don't need direct EPA regulation of what power plants do if you set the right price on carbon. Again, there is a group of folks in the world for whom that makes them really twitchy. And the reason it makes them twitchy is understandable, which is that when you go the tax approach, you don't actually know what you're going to get. And there are a group of people in the world who believe that people don't respond to taxes, find that hard to believe, or just believe that responses are small. And so while conceptually the package of levy a tax, get rid of regulations is very attractive from a certain point of view, it's actually a hard sell for a lot of folks. And so one of the things you confront is whether there are ways that you can compromise on that. And John was outlining one of these, which is that you may, like, instead of getting rid of Dodd-Frank, you may instead keep Dodd-Frank, but then add to it. And again, I would think on the political economy of this, that's actually a very useful place to think about this. That if you go with taxes or regulation, you're making your life much harder than if it's a taxes and regulation. And so in the carbon tax community, for example, we talk about suspending EPA regulations, not eliminating them. And then if the tax doesn't have its desired effect after 10 years, you can fall back on them. So think about structures like that. And with that, let me just wrap up by saying, in answer to the question posed by this panel, should we tax leverage? I want to just be completely open and honest with you. I have no idea. I think it's worth thinking about because I think leverage is a problem, both for kind of the public finance reasons that Michael went through and kind of the externality/moral hazard reasons that are out there. And I welcome this opportunity for public finance folks to work with finance folks to think about the best approach. But again, I just want to leave you with my metaphor. It is not immediately obvious to me that the externality here is like carbon. If you told me it was like lead and we wanted zero, that strikes me as within the plausible set. And if you told me it was like fish and that we want like a limited amount, known amount of leverage in the economy at all times and that would be okay, that strikes me as believable too. And I think you ought to think about which of those this is. Thanks.
Thank you. Tomas Philippon.
So I actually have slides. Okay, great. So thank you all for being here. Thank you for inviting me to discuss this paper. I should say this set of papers really that John has written on the topic. It's very stimulating. So I'm going to try to discuss what's in the paper and give you a perspective. So I think John made a very clear presentation, so you know what he has in mind. So I'm going to try to... so first of all, there is much to like in the paper. The discussion is always very stimulating. I think there is a healthy dose of skepticism about things that are often taken as given in some of the literature. Like, we see a lot of short-term debt. Oh, it must be that people love it, so we can't get rid of it. This kind of argument, actually, it's very pervasive in the literature. So I like that John doesn't like these arguments, and he says, no, you have to take them seriously and think about it. So this is very good. Also, some of the proposals, make a lot more sense once you have the opportunity or the right to pay interest on reserves. So in terms of timing, I think that's interesting. And finally, the idea of like a Pigouvian tax that has been discussed already, I think it's an alternative to the kind of regulation where you designate based on, essentially based on the SIC code, whether you're a bank, or an asset manager, or an insurance, instead to focus the regulation on a broad function-based regulation. So that I think is good. So of course, but my job is not to praise, it's to also explain what I think the issues are. So I'm going to essentially give you three points. The first, is it the case that narrow banking is going to stop runs? The second is taxing leverage. Okay, great, but how do we actually do it? And the third is I'm going to argue that actually I think John needs a model. So point number one, narrow banking. So essentially what John wants to do is take all of the liquid assets and move them into bond funds. Okay, so these are mutual funds, 100% equity, they just happen to hold bonds. So it turns out bond funds already exist. And just to be clear, as long as assets are illiquid, there is still a first mover advantage, even if it's 100% equity. So theoretically, that's pretty straightforward. In terms of empirical work, there's a nice paper by Chen, Goldstein, and Wei Zhang that shows actually that this is happening. Okay, so there is a payoff complementarity issue in bond mutual funds, even if they are 100% equity financed. If you want to see a more applied discussion of it, the blog post by Schoenholz and Cecchetti is pretty good. And the bottom line is, again, the nature of asset matters a lot. And as long as assets are partly liquid, there is a first mover advantage. Because even if you trade equity, you want to trade at the old price. Okay, now, of course, that means that if you move to 100% equity for backing credit, then you will have fewer runs. It's just not the case that you have no runs. So it's a matter of degree. Of course, quantitative differences matter, so it would still be better. Okay, but I think we have to have a more realistic view of what the end game is going to be. So that's for backing credit with 100% equity. The second one is about backing the safe short-term debt with treasuries. So that's nice. That's a very US-centric view of the world. If you want to do it outside the US, you're going to have to define which government debt is safe and which one is not. Okay, good luck with that. So it's a nice proposal. It's very US-centric. So for that reason, I think it's not going to have a big impact worldwide. Okay, then taxing leverage. So I'm not going to repeat what the other panelists have said about taxing leverage. I think the biggest advantage of taxing leverage is that you focus on a particular function in the financial system, okay? The production of safe or supposedly safe short-term asset. And you don't ask whether it's produced by a bank, an insurance company, a shadow bank, whatever. It's just you identify the issue and then you tax it across the board. So that, I think, is very appealing. The tricky issue is exactly what are we supposed to tax? And the main issue with banks, for instance, is it's very, very, very hard to define leverage. In fact, if you define leverage in the usual way, there is zillions of ways banks can take on risk, short-term risk, without leverage on the books. And contingent assets and derivatives are a prime example. Just to show you how complicated these things are, that's a picture that I like very much, actually. Okay, so you have the big players. Okay, this is for the US. So you have the big players, and every bank is observed 5 times. I think it's 5 or 6 times. Okay, these are either annual or semi-annual data. Okay, so that's why you have many points for Goldman Sachs. And of course, their books, their balance sheet moves over time a little bit, so not all the points are the same place, but you can see that they tend to stay in the same region. So what do we have here? On the vertical axis, you have the GAAP IFRS difference in equity over assets. All right, so you have equity, you divide by assets. Sounds easy. Well, no, because you have no idea what assets are. So you have assets according to GAAP and assets according to IFRS. The big difference in GAAP, you can net out derivative positions. Therefore, assets are going to look smaller under GAAP. Therefore, E over A is going to look bigger under GAAP. Okay? Now, how much bigger? Well, it depends how much netting you're doing in your balance sheet. Okay? So this is the difference. This is E over A under GAAP minus E over A under IFRS. Okay? And you can see that it varies a lot. For some, I don't have the, whatever. You can see Wells Fargo and Bonnie and State Street at the bottom left. Essentially, they don't do much derivative. That's not the core of their business, and therefore there is not that much difference between GAAP and IFRS. On the other hand, you have a small number of very large banks who do most of the derivatives trading. Okay, so their nominal positions, their face value position, is just staggering in terms of size, and of course the difference between their assets reported with or without netting derivatives is gigantic. Okay, because the average E over A is around 3%, and the difference is around 3% under the 2 accounting measures. Okay, now which one are you going to tax? Which one is the right one? I think that that's the critical issue. If you can't answer that one, it's going to be very hard just to define what you mean by taxing leverage. There is lots of short-term debt in these activities. Okay. So to me, when you think about taxing leverage, the first thing you're going to have to address is how do you take into account the derivatives market? And in particular, one thing that definitely should be top of the agenda is what do we think of the safe harbor versus automatic stay provision? This is a huge advantage that we've given to derivatives trader, and it's very hard to understand exactly why, but I think, to me, that's like critical issue number 1. If you don't have an answer to that question, the rest is kind of, moot. And it's a very hard question. If you write the model, it's actually very unclear what the optimal regulation is. I can tell you my own view. I don't understand why we give them a safe harbor, but, it's a complicated issue. The second one is, again, we're talking about global banks. Now we have lots of ring fencing around the world. So actually, even defining leverage is tricky. Are you talking about local leverage defined for the ring fence entity in that particular country, which is probably what the regulators are going to look like? Or are you going to talk about global leverage for the consolidated balance sheet of the global bank? That's going to give you very, very different numbers. Okay? So you have to decide what you're going to do there as well. So these are just 2 issues. I could list more issues, but it's going to get boring. So the point is, I think it's a great idea. but as soon as you start looking at it, it's easier said than done. I think for banking, the honest answer is I don't think it's going to be any simpler than the capital ratio, because it's going to essentially run into the same issues as defining equity over assets. So I don't think that's fundamentally simpler for banks. I think the main advantage is you can apply the same idea across the board to everybody. So that I think is a big advantage. But of course, it's going to be simple only until you start filling in the blanks. And then when you do fill in the blanks, it's going to look complicated as well. But that's not a reason not to do it. I'm just putting that out there. Our last point, that's more about the way John presents the, I understand why he does it, but the way he pictures the current framework is a bit of a straw man. There's lots of crazy stuff in there, but there's some ideas that are not that stupid. The fact that we have many elements, yeah, it's going to look complicated. That's because we don't want the banks to game the system. So we just put 5 measures, and any one of them can catch the bank who's trying to cheat. That's not a bad idea in and of itself. It's just when you have 5 ratios to look at. I don't think that's so complicated. And the point is that was done by design. Okay, so I don't think that's necessarily bad. So this is something that I was very glad to find, especially for this audience. Okay, so I think I very much like, I enjoy reading John's papers and his blog. On that particular topic, I really think we need a model. In fact, to some extent, John blames some of the other people in that literature for not being explicit about exactly what they want to tax and why they want to tax it. But he falls prey a little bit to the same issue, which is he doesn't actually write down a model. So sometimes it's fine, and sometimes it's not fine. So if you're like me and you don't really trust your intuition, you write the model because you want to know that your intuition makes sense, right? And so here's a beautiful example. Safe assets and narrow banks. So this is a quote. Of course, you see, I didn't put the name or the date or the paper, but I'm thinking there are people in this room who should know and should be able to guess who wrote that. It's somebody you like very much. So here's the point, and that was written, say, about 20 years ago. The current version of the narrow banking proposal starts with an observation. Look, there's lots of short-term assets out there that are safe, and they're outside the banking system, and it's way more than the size of the demand deposit liabilities. So why do we have to have this silly illiquid banking system? We can just change the arrows. We have more than enough safe assets. All we have to do is pick the demand deposit and make sure they are backed by this safe asset. Sounds straightforward, right? So I hope you guessed who wrote that, but I'm sure Charlie guessed, but he always guesses, so it's too easy for him. So it's Neil Wallace, 1996, in the quarterly review of this institution. And it's a paper called Narrow Banking Meets the Diamond-Dybvig Model. And the point he's making is, okay, that sounds great. Let's write the model to see if it works. Okay, so he writes a Diamond-Dybvig model. He finds the best symmetric allocation. And then he shows, and that's where it's very smart, actually, as usual, you would say with Neil. He says, look, you can actually interpret this Diamond-Dybvig allocation with a very large amount of assets outside the banking system. In fact, lots of safe assets across outside the banking system, much in excess of the deposit liabilities in the banks. So it's going to look like the system we have today. And yet, he has a proof. That's proposition 3. So the point is, he's setting up a model which is consistent with the fact that there is, maybe 15 trillion of safe assets and only 5 trillion of demandable deposits in banks. So his data is consistent with this fact, and yet he shows that any narrow banking is equivalent to autarky. Any narrow banking equilibrium, defined as you force banks to be 100% liquid in every state of the world, then the allocation of any equilibrium under that world is an allocation which exists on autarky. In other words, you just remove entirely the financial intermediation part. Okay, so that's why you need a model. Because it's not obvious. If you don't have a model for why banks exist in the first place, it's very hard to make the claim, oh, I'm going to change the arrows and the equilibrium is going to look like that. Well, you don't know. Okay? So I'm not saying it's not possible. I think that's why I want to see a model. It turns out that we've been thinking about that question for a while. And so we have some ideas about how you write such a model. So the point is, I think, I'm happy with shortcuts, but if you're going to tell me that you want a Pigovian tax system, I want that to be the solution of a planner's problem. Now, you can make shortcuts in the planner's problem. You can make it simple. But if you're going to say that's the optimal tax, I want to see the planner problem that's underlying this. And so we try to do that for banking regulation. And it has some of the features that have been discussed. So it's not that, it's not very complicated. Well, the model is not very complicated. The tax formula is a bit complicated. But in the simplest version, and for banks, it boils down to something where you tax systemic risk, which is measured as your capital shortfall in the crisis states of the world. Okay, that's the Pigovian tax. That's what the planner would do. There's a bunch of constant in front of this term, but the key feature is this. And by the way, it actually it's very related to what Donald was saying. You see these eyes there? This is because this tax rate should depend on some features of the institutions you're taxing. So you're taxing leverage because K is like your capital ratio, A is your asset, and W is your net worth. So this is that's leverage already in there. But you're not taxing leverage with the same tax rate for everybody if the correlation of their assets is different. If they are, depending on the kind of risk they are taking with their balance sheet, you're going to tax leverage a bit differently, which may or may not be a good feature. It's hard to implement. Okay? We show that you can actually estimate these things in real time with market value. So on that, I'm completely with John. We should use much more market value for this kind of regulations. So it's feasible. I just want to point out that, so we've been thinking about this model more today because the debate has moved away from banking towards other financial firms, in particular, say, insurance companies. And again, it's striking to see that the debate is really completely confused there. It's confused on both sides. It's confused on the insurance company side because essentially they are saying two statements that are kind of inconsistent. We are saying we are vital to the economy, whatever vital means. I think it means that I'm very important. If I disappear, you're in trouble. Okay, so that's vital. So they say we are vital to the economy, but don't worry, we are not systemic because we don't have runs, unlike the banks. Well, the fact that you don't have runs doesn't mean you cannot go bankrupt. So then you have to tell me you're vital, but somehow if you're completely insolvent, it's okay. Is that really possible? And it turns out the debate is confused because nobody wrote the damn model. If you put down the equation, you start to exactly write down what these things are supposed to mean and taking lots of shortcuts. Okay, so this is not like a deep structural model where everything is pinned down from first principle. There's lots of shortcuts in there. But even these shortcuts are useful and you can answer questions. Can you be vital without being systemic? Is it the case that only firms with runnable liabilities are systemic? Okay? And the answer turns out to be, so the model is exactly the one you would think, which is you have a large number of firms that choose asset allocation, leverage, maturity. So you can talk about short-term versus long-term debt. We have a market for takeovers, either of assets or takeover of institutions, like the FDIC does with banks. And we have a market for new investments. You can discuss what a credit crunch is, right? So these are the obvious elements. You put them in there, and then you just set up the planner's problem, okay? And as soon as you do that, you realize that there are two externalities that are going to interact. One is a credit crunch externality, which is what you care about is credit to the real sector, okay? The other type of externality you care about is a disruption liquidation externality, which is current services being uninterrupted. People who were hedged who are not hedged anymore when the counterparty disappears. Okay? And then you have these two very natural sources of externalities, and then you set up the planner's problem, and it looks like a Pigovian tax is the optimal solution. And of course, you have two externalities, so you're going to have two tax rates. One tax rate, which is going to be related to the credit crunch externality, and the other one to the disruption externality. Okay? And then you can ask, what makes you more systemic, or in the context of the model, when is it that I want to increase your tax rate? And yes, it is absolutely true that if you have more short-term debt, both of your tax rates are going to go up. Okay? But it's also true that even if you don't have any short-term debt, you can have a positive tax rate. Okay? And the reason is that you're still participating in this assets market. And if you're insolvent, you are not going to be buying these assets, and that is going to actually have an impact on the credit crunch externality, even if you don't yourself issue short-term debt. Short-term debt is going to make you more systemic, it's going to increase your tax rate, but it's not the case that in these models, the tax would be zero for somebody who doesn't have any short-term debt. The tax would be zero for somebody who is 100% equity financed. That is no short-term and no long-term debt. That is still correct in this model. So the point is, I don't know that this is the right model. The point is that you need to write down these models just to figure out what are the key ingredients and whether what we think is true is actually true and actually logically consistent. Okay? So just to conclude, wrap up, if I want just people to take away a few things, the first one is measurement for leverage. I think that's critical. And, we should just be talking about derivatives, essentially. Derivatives and contingent asset. That's what's going to be hard to measure. And then we want to have a serious discussion about safe harbor versus automatic stay in the derivatives market. I think that's, if you want to tax leverage, that should be a big item on the list. Increasing equity, I think it's a great idea. On the other hand, the 100% equity proposal, to me, it sounds a bit like the debate about inflation targets. Now, we can't even get to 20. Now we're going to propose 100. It's a bit like, the economy is stuck at 0% inflation. Our target is 2. And we say, oh, I'm going to raise the target to 4, and magically, inflation is going to go up to 2. Well, I don't see that happening. Okay, so I think it might be a nice, it's a way to provoke the debate. On the other hand, I think the path along the way is probably very important, as much as the target. Thank you.
Thank you. So before we turn to audience questions, John, do you want to take some time to respond?
Yeah, I talked really fast the first time around, so I would have a little time now. And actually, who's in charge of the slides? Can you put up my slide with the arrows and charts for a second? So these are just great comments, and I've learned a lot. Thank you all. And I don't really want to respond as much as cheer to a couple points that I want to bring out. So I want to admit, so 100%, go back to, I want the arrows and graphs. Numbers 1, 2, and 3. There we go. Okay, we'll get there. So now I can come out of the closet and admit, this isn't 100% is not necessary. I put 100% equity, most of all to emphasize, especially to us economists, this is entirely possible. So once you accept that 100 is possible and reasonable, it might even work, then 50% might swell is a lot easier. Because in fact, this is not a case, so to John's point, it's not a case where 0 is in fact the right answer. Once you got 50% equity, 70% equity, the chance of a run bringing down the institution is next to nothing. So the danger is past. And in fact, not all debt matters. What really matters is run-prone debt. So like your gas bill, there's a fixed value promise, and eventually you got to pay it, or else bad things will happen. But if you don't pay your gas bill tomorrow morning, they can't send you into personal bankruptcy court. So, fixed value promises that don't have the right to instantly you go bankrupt if you don't pay tomorrow morning really aren't that much of a problem. So it's a small part of the debt, actually, that's the big problem. Michael echoed this problem of, wait, how in the world can you ask banks to issue so much equity so fast? And the key is you don't have to. So that sounds like, oh my gosh, we need all this new money. And I want to stress, no, we don't need all this new money. The current money is sufficient because as you're issuing new equity, you're also retiring debt simultaneously. And so you could do that, you could actually do that slowly. Every time some debt comes due, issue the equity. But you don't even need to have to go that far. So here's a clever proposal that occurred to me while you were talking. So let's look at proposal number 3 there, where there's the holding company in the middle. We could do this overnight. You tell the current equity and debt holders, by the way, what you have, the claim is exactly the same, but it's not called bank anymore, it's the ABC company. So just, a little paperwork thing. You don't need any new money. It's just you are now a holder of this mutual fund, not a holder of something to the bank. And then the mutual fund, and then the bank simply issues, it now is absolved of it gives its equity and debt to this mutual fund. It takes and issues in return the equity. It takes a bunch of lawyers, but you could do this in a night. Nobody has to provide any actual new money. In reality, what I think happens is you start taxing debt, and companies will gradually go that way fairly quickly, especially with a regulatory safe harbor. They might discover that this switch of debt for equity is easier than they thought. The importance of large banks. This is something that I really learned from Michael last night, especially because we had a glass or two of wine, so I really got the importance of it. But I think this is a point. Equity finance, lots of equity finance would allow us to have very big integrated global banks that you want and not have to worry that they're too big to fail or need to be broken up or so forth. So I think that letting them take these big complex risks over borders and so forth, we can do that if we're not holding the bag and they haven't issued a lot of debt. So I think it's actually an argument for it. So on to Michael for a second. There's a very good point here, which has been bugging me. My first reaction was to get to deduct dividends just like you deduct interest. But the problem with we get to deduct dividends is we want banks to retain earnings. I mean, what's the number one way to build equity in response to Michael? Number one's problem is retain the dividends, don't pay them out. And deducting the dividends would give an incentive in the other direction. So I like the proposal that we should, deduct the entire return on equity, but then there's this notional return on equity and not the actual return, and it starts getting all complicated. So I think this makes a strong argument why the only sensible, and also then there's the problem of all tax stuff is that the tax that matters is not just the tax you pay, but the tax that the other guy receives, and then that leads you to tax clienteles, and that's a lot of the reason why we have different assets that are into segmented markets, because they only go to specialized clienteles. And then my head starts to hurt, and the only thing that makes sense to me is eliminate all taxes on rates of return, no corporate tax and a flat consumption tax, and all of this goes away. So much for dreaming, but that is the way it all goes away. I don't know if Luigi, I saw Luigi in the back of the room. Luigi will have to comment at lunch over Italy being praised for having an excellent tax system in at least one department. That will certainly come as news. I love Donald's comments, and as I was critical of simultaneously taxing and subsidizing things, you mentioned carbon, tobacco, and sugar, all departments where the federal government is simultaneously taxing and subsidizing things. But he said it was a good idea, that taxes are good to undo what the government is doing elsewhere, and that strikes me as something we should fight hard. If the government is simultaneously taxing to discourage something that it is also encouraging somewhere else, what we get is double the inefficiency, double the lobbying, double the political economy problems, all to get back where we started from. Now, brilliant. Is this a price issue or a quantity issue? The reason I like prices rather than quantities is if you set a quantity limit, you don't see the shadow value. I mean, we all know they're the same thing in the end, right? A quantity limit has a shadow value. That's the same as the price. But when you set a quantity limit, you can't see the shadow value. When you see a price limit, then you see the shadow value. It's one reason I like prices. Prices, I think, are good in cases like pollution where the costs are hard to see. Where zero doesn't really matter, you just need to be somewhere in the really big equity department. And where the costs are hard to see, and if asked to do stuff, people complain about the costs being enormous, but you, the regulator, don't really know what they are, and there's multiple different ways to achieve something. That's exactly what I think it is in this case. The banks are screaming, "Oh, we can't issue equity. It's impossible. It's impossible." Okay, well, pay the tax or issue the equity. Oh, gee, we found a way to do it. It's not that hard after all. I think his comment that we shouldn't use the word tax outside of this room is excellent. Economists use the word, when economists say tax, we think margins and incentives. When people outside the room use tax, they think transfers of income, and there are no margins and incentives, and we should always remember that. I will use the word fee henceforth. Thomas said something that I think needs to be clarified, because the points are good. Mutual funds, which I praised, actually can have little runs in them. Now, banks promise you your full money back whenever you want it for a year, and that's a problem. Mutual funds promise your money, they set a net asset value, and then you can get as much as you want in a day. And there's a potential for a little run to happen there as well. And so I'm not sure if that's a serious issue or not. A lot of mutual funds have gone to small load fees if you try to transact too quickly at the net asset value. But there's an answer. The exchange traded structure is really run-proof in that way. And I think it would be good for mutual funds at least to have this as well. In an exchange-traded fund, if you want to get out, you cannot go to the mutual fund and say, give me my money at net asset value. You have to go sell the share to somebody else. And the fund itself is immune. That's a great structure, which I think solves a lot of the problems. He encourages me to a model, and I'll only say I haven't done it because I'm not smart enough. For me, the model is Modigliani and Miller, complete markets. The world is great, and that's just because I can, like the drunk who looks for his car keys where the light is, that's where I can do it. But is a very important point in what we do in finance. The words like information sensitive, systemic, liquidity, contagion, imbalance. We use all these words. These words are way, way ahead of actual modeling. Modeling is way, way ahead of actual empirical verification of how the world works. And policy, of course, jumps on the word, last night's word, which is, I think, a dangerous part. I want to close with something several of you brought up, sovereign debt. Thomas, whether it works for countries outside of the U.S., the first Michael was worried about inflation and sovereign debt. That is, so in what I set up, I sketched a view of the world where our interest-paying electronic money is short-term government debt. And that's the world we're in now. Unless you're having, a late-night bull session with too much beer at the Cato Institution and you're thinking about gold and Bitcoin and so forth, our world is electronic money is short-term government debt. And I kind of went in that direction with this. But there is a weakness. Our sovereigns are highly indebted, and it's not clear whether they're going to pay it off. Every crisis comes from an unexpected source. Nobody worries about sovereign debt. Well, that's probably why we might worry. So here's the nightmare. I think it's a 1 in 1,000 possibility, but now that I live in California, I worry about earthquakes in the middle of the night, even though we haven't seen one in a long time. The last magnitude 9 was 1850. It can happen again, though. And the nightmare goes something like this. And basically, Greece comes to the U.S. We discover, for example, that a lot of people in China have lent money to other people, and the accounting's a little suspicious, and a lot of people can't pay that back. We discover that the state of California and Illinois have promised their pensioners a lot of stuff they can't pay back. Governments, once again, we got to dip into, the U.S. spent about $5 trillion on the last one, so massive bailouts go around. Maybe some European southern countries go under. Governments need to sell another 100%, another 50% of GDP in debt. Debt markets start going, guys, I'm not sure you're ever going to be able to pay this back. We get into a rollover problem. And now, in my world, even more than today's world, our financial system is deeply reliant on the solvency of governments. So a sovereign, Greece comes to the U.S. is not completely impossible. And I was, if interest rates go up, say to 5%, the U.S. has to pay 5% of GDP more in debt service, and that's got to come from somewhere. So these problems could happen, and just because I ruled them out doesn't mean we shouldn't think about them. I'm done.
Thank you. So we've got a little more than 20 minutes for audience questions. Let me just remind everyone, since this is being live streamed, please be sure to speak into a microphone so that our web audience can hear your question. And there are people moving around with microphones if you don't have one on the table in front of you. Patrick.
Thank you.
Yeah, I was just going to ask you a little bit about when people think about putting on more taxes or more constraints on the financial system. It reminds me of the old development literature about the trade-off between financial liberalization and growth. More liberalized economies financially tend to grow more. There was hundreds of growth regressions on that, some better, some worse. So you're trying to propose a system that fixes a problem, but somehow doesn't interfere with growth. In your simple examples, it was completely equivalent. And then more generally, I just wonder if you guys can chat a little bit about these particular policies. Do you think you can achieve the ideal of eliminating these crises without having any impact on the total financial sector, growth, output concerns, et cetera? And can you hit it, on a nail? Or do you think we should always phrase it not, should we try to eliminate crises, but what is the trade-off between regulation and growth, and where do we want to choose to be on the spectrum? Thank you.
So I want to sell, and by the way, thanks to Pat for emailing me this question last night, so I have some vague hope of answering it. I want to sell what I'm offering as much, much less constraints on the system, and therefore much more growth. Because you may have in mind a system where there's completely no regulation whatsoever, but that's not the choice. The choice is between our current system with a huge amount of regulation, and so by just having a little bit of, I don't even think we need the tax on debt. I think the safe harbor and getting rid of the subsidies of debt would do the trick. Maybe a little tax on debt if you need it. But then you can get rid of asset risk regulation, all the sort of anti-competition regulation. Banks can be free to go innovate, get into the financial technology business, make loans to interesting new people, find interesting new ways to fund stuff. So I think by having an alternative to the intense asset risk regulation, and now the attempt to actually regulate market prices themselves and who can buy and sell stuff. I think the whole point is to unleash growth and innovation.
Maybe just one thing on Pat's question. I mean, some of the literature you're mentioning looked at the historical data, and in the historical data, it is true that higher credit to GDP was a pretty stable predictor of future growth across countries. And so then if you think higher credit to GDP also creates more risk, then there's a trade-off. So you have some kind of Pareto frontier which is downward sloping. But today, actually, at least for advanced economies, just no evidence that more credit predicts more growth. And there is evidence that it predicts more crisis. So so the trade-off is probably, I view what John is saying as the trade-off should be dead weight loss of regulation, as opposed to maybe just like the old trade-off. So then you really want to think about perhaps a simpler regulation would have lower dead weight loss and then higher growth.
Michael, do you want to offer any perspective on this from the IMF, since the international comparisons seem relevant to you?
No, I don't think so. I guess there's a trade-off too between having a stable, steady rate of growth and being kicked down off the path by crises, which we know take a long while to get back. I don't know how that tracks out. But.
Thank you. Neil.
Just considering the notion of taxing debt, I'm curious to Michael Hassenstab, as a fixed income portfolio manager, if financial institutions in the U.S. had to pay the Cochrane 5% tax, and that's banks and non-banks and insurance companies. So the issuer would pay the tax. Presumably there'd be less debt issued as a result of that. Other than that, do you care as a portfolio manager? Do you think it'll affect your business or your clients whose money you manage? Or do you think it won't affect you?
I guess my question is more, what would it do to the market-making capacity of what would it do to the market-making capacity of those broker-dealers that set the marketplace? And if, as you're proposing, it simply got passed off to the issuer, they didn't have to cut back their ability to make markets, the impact on us wouldn't be there. So I think in a perfect world, if you were to somehow go from point A to point B, which is 100% equity, and it all works, you can see a solution which I think is quite elegant and interesting. My concern is more the practicality of being able to get to that point. Seems a lot, but.
Chari.
V.V. Chari, University of Minnesota. A narrower observation, and then I want to step back a little bit. The narrow observation, and Donald Marin brought this up, and as did Michael Keene, it's this issue about prices versus quantities. I want to emphasize one thing that I think is relevant. In a large class of situations, and models for that matter, prices and quantities are equivalent in the following sense, which is that you can either impose a tax or you can set, for example, an aggregate limit on the quantity, but allow people, firms, others, households to trade, in which case you do get the shadow price that that John was concerned about. So in my mind, the real issue is not a tax or a limit on the aggregate amount, but rather what John is suggesting, I think, is that the current system we have is a system where we try directly to regulate the activities of individual firms rather than setting up a tradable permit system or a tax system which recognizes a central feature of modern societies, which is that regulators and governments have a lot less information than private agents and markets do. And that's I think, the essence of this. I think it's a little bit of a red herring whether we think about it as a tax or a tradable permit system. I think both of those are, each one of those has merits depending on the particular circumstances. I want to step back to something broader, which I got from John's paper and his discussions, but I don't think was emphasized enough today, which is there's this correct bias among economists, which is that if markets are producing a particular kind of answer to a particular solution, to a particular problem, then we should start by understanding why markets are producing that answer. The Western Industrial Revolution, according to economic historians, rested in an important way on innovations in Western financial systems. In particular, the invention of banks, the invention of deposits, debt claims, and all the rest of it played a very important role. What John is suggesting, I think, is something very important, which is, had we allowed that system was right for 400 years. The system we are now capable of having, which is a modern mutual fund or an ETF-like system with tradable equity-like claims, was simply inconceivable in 1920. Until the IBM 360 came along, the idea that you would be able to calculate net asset values for millions of potential holders of claims just couldn't do it. Didn't have enough people to be able to do that. And so technology has changed, but we are arguably, I think John is correct in this, we are frozen in the intellectual amber of regulatory orthodoxy, which has led us to believe that a system which was correct and appropriate and worked very well for the 18th and 19th century is the right system for the 21st century. And this has a lot of bearing to what Thomas was saying. The issue is not whether there are runs or not. The issue is, are you led to liquidate assets which have a large continuing value? Are you led to a system where new investments are not undertaken? The fact that there are a whole bunch of equity claimants who suddenly find that their stuff is worthless and some guys got ahead of other people is irrelevant to whether the existing entity continues to make the right kinds of loans, continues to make the right kinds of investments. That is what, as economists, we ought to be concerned about. It's not so much providing a run-proof financial system as a system which avoids premature and inefficient liquidation of valuable assets.
So I think that's a directly contrasting view of what the problem is that you proposed at the beginning, John. Do you want?
Well, I thought he was cheering completely, and just to amplify. In the state of nature, banks chose like 40% equity. So we've seen this before. That wasn't quite enough, but that was plenty. Then in the Great Depression, we had our huge run. And these issues were debated. There was the narrow banking proposals versus the guarantee deposits and try to regulate risk proposals. And we chose that. I don't think we need to refight the debates of the 1930s. But I just want, what Jari said is what I said briefly. We now have options that they didn't have. You could pay for water by swiping an iPhone and selling a share of an S&P 500 index fund. And that simply was not possible in the 1930s because of communications technology. You didn't know what the S&P was worth. Transactions technology, we could do this in 20 milliseconds. It took days to settle stuff then. You had to actually take certificates out of your safe deposit box to do that. And because of financial technology. The individual stocks are information-sensitive securities. They have bid-ask spreads. They have asymmetric information. An S&P 500 index fund is immensely liquid. It is almost an information-insensitive security. So all of those three things make liquidity, the ability to sell something immediately with very low price impact, divorced from fixed value. In the 1930s, the only way for something to be liquid is if it says, I will pay you $1, and we know exactly what the value is. Now we are at least open to much greater use of floating value, run-proof securities for liquid assets. Now, Chari pointed out a weak point in what I've said, and I think a weak point in what we all do. In the Diamond-Dybvig model, in all models of runs are not socially inefficient unless a real project gets abandoned halfway along the way. And selling a basket of mortgage-backed securities in a fire sale to somebody who was smart enough to sit around and keep some cash going is not abandoning a real project in midstream. So there's actually, I let that pass, but whether even, Lehman Brothers going under, does that qualify as Diamond and Dybvig? Ben Bernanke's view of the Great Depression was brilliant. The problem is that the operations might not succeed. Lehman's operations were open the next day because those went off to a new bidder. So that's not the problem. And selling a bunch of mortgage-backed securities to somebody who makes a lot of money off of it, that's actually good. That encourages people to keep some cash around next time so that they can buy in the buying opportunity of a lifetime. So now there's a lot of empty houses that maybe should have been completed or maybe should have been burned down. But you're exactly right that one of the biggest weaknesses we all have in describing what's a crisis is pointing out just how this propagates to a real investment opportunity that should have been completed and that wasn't. Yes, in the back.
Luigi Zingales, University of Chicago. I agree with John that if Italy should be the example of a recapitalization of banks because the tax system is so good, I think the tax system doesn't work. So we should think about other solution because the capitalization of Italian bank is not particularly good, especially in this moment. I have more doubts on John's proposal. There seems to be a bit strange, especially coming from John. Because what you are proposing, if I understand correctly, John, is a nationalization of the banking system. Because basically banks, at least the way I understand banks, is that advantage that they issue an instrument that is considered money. So they create an instrument that has an advantage, and competition, at least ideally, we base some companies, to borrowers, and so to companies. What you are saying is that you want to limit this right only to the government, so that all that advantage is given to the federal government, that will clearly motivate the federal government to spend. So it seems a bit paradoxical coming from you. What I'm missing here?
Nothing. Luigi, as good a free marketer as both of us are, there's a few things the government has a natural monopoly in, national defense, courts, property rights, and I think money is one of them. And my analogy is, in the 19th century, banks issued notes. So we had private issue of actual cash money, banknotes, and as you know, that didn't work so well because there's runs, there are all the problems of banknotes. Late 19th century said, you know what, we're done with this. The Treasury will issue notes, and it'll have a monopoly on the issue of notes. And kind of that problem went away. And now we have electronic money, interest-bearing electronic money. We have almost exactly the same circumstance. We had banks were providing lots of this interest-bearing electronic money, especially to corporate users who had too big needs. They couldn't fit under deposit insurance. And that stuff blew up. And the Treasury and the Fed together have a natural monopoly in providing fixed value, floating rate, default-free stuff. And every now and then, the government's got to do what it's got to do, what it does best. That's one of them. Silence Luigi. This is like a world's first.
He's talking over lunch. He'll have time to catch up.
I have a good friend who's works for an investment bank, and he covers the commercial banks primarily. And in a conversation with him not too long ago, he kind of jokingly said we are in the golden age of regulatory arbitrage, and showing me examples of some of the things that have done post-Dodd-Frank. And in kind of the world of keep it simple, stupid, although Basel and Dodd-Frank would seem to point the other way, is there any unanimity one way or another on the panel or what you know of in the industry for trying to make the regulatory side more simple, leaving it at it is, or trying to make it more complex?
Does anyone want to?
And who will stand up for we need more complex?
I think, I'm not sure complex is always the best way to think about the way it was designed. So there is like some of the things that look very strange today, they come from political compromise. So there is no point trying to find economic rationale behind them. There's just, 10 people sitting in a dark room in Basel, and they all have political agendas, and that's how they make the decision. So that's maybe 30% of the regulation. So there's no point arguing whether we like them or not, or just that's it. Now for the rest, like for me, just having several ratios, like having should we keep equity of our asset plus equity of our risk-weighted assets? I think it makes sense to have both. I really don't think that's that complicated. So yeah, that means you look at 2 ratios instead of 1. I don't think that's complex. And for liquidity, having 1 ratio for liquidity also, I don't see the harm there. I think the complexity, the main issue in my mind is derivatives and outside banking. I don't think the next crisis is coming from commercial banks, honestly. This is not what's going to happen. And the regulatory arbitrage, big time, it's not among commercial banks as much as between entities. I mean, if you look at the same portfolio and you look at insurance regulation versus bank regulations, then you're going to factor of 10 for the amount of capital you're supposed to put behind it. And that's a big regulatory arbitrage. It's not within banks.
Could I add? I think I forget who said we should understand why the world is the way it is. There's a reason we got complex. And that's because if you set up simple rules, the banks, the institutions on the other side who have far more information know how to game them. I remember talking to some of the guys who were setting up stress tests, and I said, why don't you just, you're not why are you making up new stuff on the fly? And the answer was, well, if we tell the banks what the rules are ahead of time, then their clever guys are going to find some way around the rules, and that's the end of that. We got to always try to surprise them and keep them on their feet. And another reason regulation, because I think we use 2 simple words. Regulation isn't more or less. A lot of the point of complex regulation is that gives discretion. And one of the biggest issues in regulation is it rule-based or discretionary. Well, a big complicated rule book is basically the way the guy says, Pat's doing something I don't like, then I can't just say, Pat, stop drinking water, you need to drink beer. I got to go, well, the interpretation of Rule 39C, paragraph sub 2 says you ought to be drinking beer, Pat would game it if that was actually written down. So discretion versus rule-based, full of unintended consequences versus actually works the way it should. There's lots of dimensions of regulation more than just more or less or transparent and simple.
Yes.
Thank you. Hi. I have a certain amount of sympathy with Thomas's view, but I think he's underestimating the amount of complexity we actually had. 2 or 3 months ago, I actually counted the number of capital ratios that large U.S. banks must meet. And this is strictly in the U.S., not what they have to do in the 60 or 90 other countries they are active in. 38. And it's true there were a lot of political compromises behind them, but it's surely an excessive amount of probably even contradictory constraints that we're requiring banks to comply with that I really don't think is limiting arbitrage. I think it's simply making it easier because it's more opaque to get around it. Now, there may be more because I did this count 3 months ago, and they seem to pop up every month, but it's a lot.
Let me give Jim Bullard the opportunity to get the last word here.
So Jim Bullard, St. Louis Fed. So John, should this new tax on debt finance be a global tax?
First of all, echoing Donald, please always to call it a fee. I'm never going to use the word tax again. So yes, of course. I mean, but I'm leery of don't fix your own problems until you can get the whole world to go along. The U.S. is big enough that I think we could lead on this, and then the rest of the world would probably follow.
Well, would
I
there
don't-
be
and-
incentives for big firms to go overseas, and would you care about that?
Yeah, I want to make it attractive to work in the U.S., and that's why I really want to. The title of this got the Pigouvian tax got on the title, but I think the removing the distortions in the U.S. in favor of debt, and the regulatory safe harbor. I want to make this attractive, and banks would come running if they got a regulatory safe harbor in return for for changing their capital structure out of debt, and then then companies would come to the U.S. because it's the great new wild west of competitive banking, as opposed to we're driving them away with some new extra impediment.
Thank you. Well, thanks to all of you for the great discussion this morning, and let's thank our panelists one more time. So lunch will be upstairs on the second floor.